We have already been shifting clients' assets into gold, into other precious metals. Generally speaking, if you look throughout history, the one benefit of gold is it's been, long-term, it's been a very good inflation hedge. The price of gold at least keeps up with the rate of inflation. Now, we've been arguing or making the case that gold has been undervalued because it's been in a 10-year bear market, and gold needed to come off the bottom relative to other asset classes, and that's the first reason we put it into client portfolios. But now we're looking at gold very differently. We're saying that you have an asset class that is, number one, it's uncorrelated to stocks. Number two, you have a bond portfolio that's very likely to under-earn inflation. And there's an asset class not correlated to stocks that historically at least keeps up with the rate of inflation. So we'll put some gold in. We've put it in both our stock portfolios and into our bond portfolios. The downside to having gold as a replacement to bonds is very similar to the downside of adding extra stocks to the replacement of bonds, is that the price fluctuations in gold can be much wider than they typically are in a bond portfolio. Sometimes people lose sight of how volatile a bond portfolio is as well. With interest rates so low, take the 10-year treasury so far this year. The 10-year treasury started the year well above 2%. It bottomed at less than 0.5%. And today it's getting very close to that 1% range. What people don't realize is from the bottom of interest rate, the bottom of the interest rate market in June to now, they've probably lost close to 10% on the par value or the market value of that bond. That incremental move of 0.5%, it's not going to be quite 10%, it might be like 7%, but it's a pretty significant move in the market value of that bond. Because anybody that bought it in June at 50 basis points, that's all they can earn for the next 10 years is 50 basis points.